Hey, everybody, this is Charles Dobbins, the founder of the Multifamily Investing Academy and the creator of the Multifamily OS system. And I'm here today with Jason Lee of San Diego, of all places. I mean, he's a highly sought after real estate agent who focuses primarily on multifamily real estate. So we're going into the lion's den on this call today with a broker. He's helped over 50 investors and has sold over $100 million worth of property in San Diego. So we're finally going to this podcast will be coming to you right around, November, December of 2022. We all know what's going on with the world right now. And now we get his perspective. And the only problem with his perspective is the fact that he's in California. And that's a different world compared to a lot of other places. So let's find out exactly how much different there is. So Jason, welcome aboard, buddy.
Hey, thanks for having me, Charles.
Sure. Now let's talk about, you seem like a young guy. You got into the real estate business, and then you made the decision, obviously, to focus on multifamily. Did you start off in multifamily? Did you learn residential and decide, hey, I like multifamily better? How was your progression?
No, straight out of school when I was a junior at San Diego State, the first person I met that I wanted to work with was a multifamily broker here in San Diego, very prominent guy. And I've never sold a single family home. I've only sold commercial and multifamily properties my whole career. I kind of dove right into it day one. I never got into residential before.
Now, was this guy with one of the big houses like the Marcus and Millichaps, or was he out on his own?
No. He had a decent sized brokerage. I mean, he had two offices, one here in Northern California, probably had about a total of 30 or 40 agents. So it was like a small to medium sized company.
Okay. See, when I teach my students on how to go out there and find multifamily, I said, you got to find those brokers that fly below the radar. And I'm talking about you when I say that. Guys like you that aren't with the big Marcus and Millichaps, aren't with the big CBREs, but you guys, whenever I've met people like you, they have always known the market that they work in better than anyone else. They're an expert on their market. So is that kind of like, how does that describe you?
Yeah. I come from a small shop. I get what you're saying because the training we have is a little different. In my opinion, I think the big corporations only care about, getting the property listed and marketing it far and wide, where I usually skip that step. I usually kind of like most of my deals are done off market. So a lot of my clients are getting really good deals before the competition hits on the internet. So that's how I've done my business, and it's worked really well for me.
Okay, that's interesting because when I've sold some of my properties, I'll tell you, you tell me how accurate this is. When I'm looking for properties, I would never buy up from a Marcus and Millichap. It's retail, it's overpriced. But I'll tell you, Jason, whenever I've sold my properties, they're the first guys I call. Because they have a bandwidth of stupid investors who will just pay top dollar and close in no time. And what do I care? I'll unload that. So, but you keep these things off market. You're just doing everything pretty much through word of mouth. You've got these, so you get a stable of investors looking to buy, and you're on a first name basis with all the multifamily owners, and you're just kind of like matching the two of them up.
Yeah, but I also cooperate with, brokers. I feel like firms like Marcus, they kind of like to double end everything. So it kind of puts a bad, it puts a seller at a disadvantage from what at least I see in California.
Okay,
that's other markets.
Okay, so here's what another thing that I teach my students is never sign a buyer's agreement in multifamily, because if you do, those brokers who have been killing themselves trying to get the listing are not going to give you the time of day if they have to split their commission with some other broker. I mean, what are your thoughts on the buyer's agreements?
If you're looking to buy multifamily, I would never sign a buyer exclusive agreement ever. Being a buyer myself, I would never do that. And what I was saying is that when you list your property with, someone like Marcus, I mean, let's say you offer a 4% commission to them and whoever brings the buyer. 95% of the time, Marcus works with someone in-house, right? So that's what I was saying.
Okay, I have a big joke in my amongst my groups is that I have a bumper sticker on my car that says LoopNet is where deals go to die. No, actually I have two bumper stickers. So I have this saying, LoopNet is where deals go to die. And the reason why I say that is because, like you just said, when a broker gets a deal in-house, he's going to try to, keep both sides of the commission and, run it past his stable of investors first.
Yep.
If no one buys, then he offers it to the guys in his shop. And if nobody buys, then he puts it out there to the world. So this has already been cherry picked, and passed over. And that's why it's ending up on LoopNet, where it's gone to die. I mean, how accurate do you think that statement is?
No, it's very accurate.
Yeah.
If you're an investor looking to get into multifamily and you don't have the broker relationships, your first move is to go on LoopNet, right? But little do you know that deal has been shopped by every big investor in town, so it's probably a bad deal. So I would never. I mean, unless the only time you would ever buy a deal on LoopNet is if the person who listed the property is some like residential realtor who has no idea what he or she is doing, because that's when sometimes the deal is very mismarketed and priced very wrong. So that's when it makes sense. But like if a guy who knows what he's doing or gal posts a property on LoopNet, then 9 times out of 10 that property is gonna be way too expensive.
Yeah. Okay. Another thing is I also tell my students that the sweet spot to get started in this business is the 10 to 50 range, 10 to 50 units range, because it's too small for the big guys and too big for the residential realtors, who are the ones that they tend to think they've hung the moon when they get this type of a listing, but they don't know what the heck to do with it. So that 10 to 50 range, go direct to the owners. Speak. You can pick up the phone and talk to that person. I mean, but you're in San Diego. That might be a lot of what you do, is that size property.
Yeah. That's like 95% of my transactions.
Yeah, because it's so expensive. There was one rule of thumb that when I was looking with the properties that I own, we always purchase at least 120 units so that we could have 2 people on the property. I was analyzing a deal for a student, and it was like a 70 unit deal in San Diego, and it came with 2 employees. And I thought, how can a 70 unit property sustain 2 employees? And the answer is because of the rents are so ridiculously high in San Diego. You can do it. So, I mean, there's another thing, and you got to correct me if I'm wrong on this, and this isn't just LA, or this is all of California. If you own a 16 unit property or more, you have to have an on-site full-time person. Is that right?
Yep, you're correct. Yep.
What the heck? What is with your state? It's crazy. It's absolutely crazy.
Yeah, there's some, unfavorable laws for landlords here, but every investor I've worked with over, 100 investors here in San Diego, big and small, and they've all done extremely well. I mean, if you know how to get around some of the laws, which you always can, unless you're buying in core San Francisco or LA, then you're screwed. But cities like San Diego, there's still, some sort of aspect where landlords can get away with, moving out tenants and kind of doing their thing. And, rents have gone up here, at least 7% a year or more for the last decade. So it's done really well.
All right. So what do you think's coming up? What's coming up? I mean, I see it all over the country. Different places act differently, obviously. California, none of my clients are looking to buy in California. Many of them live there, but they just can't get numbers that pencil out. Obviously, for the last couple of years, you guys have been riding a wave, and it's been great. What's going on now? What do you see happening?
Well, I mean, the market's still pretty strong here. I mean, San Diego's always been a very recession-resistant market. Places, I know buyers who bought in Las Vegas and Phoenix who are getting destroyed right now on cap rates because the rates going up. That's not happening in San Diego. I mean, there's still 4 caps trading here. I mean, I'm in escrow on a large deal that's, trading at like a 4.1 cap. It's not even in that great a condition. So I just think there's still a lot of demand, a lot of liquidity looking in San Diego. There are less buyers, and it's not going to be the same as it was before, but I definitely don't see the market tanking like a lot of people think it's going to happen in other cities. So,
all right, the deal that you have in escrow right now, how has the interest rates affected that deal?
I mean, we went into escrow like 2 weeks ago, so rates were already at its peak. But I did have some deals that did go to die because the rates rising so fast. Banks would pull out. They would not perform on their LOIs. So, I mean, the last 4 months have been crazy.
Yeah. Okay. Because that's what we're seeing here. I just got this update from a guy that I do business with. And he gives a couple of bullet points. He says, first example, he says, in Texas, we sourced a new construction asset off market in the second quarter with pricing guidance at 95 million. By the third quarter, that guidance had dropped to 75 million. We originally submitted an LOI at 70 million, and now even that price is hard to pencil. And that, I mean, he goes on and on and on with all these different types of deals that are caving because of first off interest rates. But now you say well, maybe you didn't say, but are your rents remaining stable, or are you starting to see landlords coming down on the rents because vacancy is starting to increase?
No, vacancy still at 2.7% in San Diego, from a recent report that came out from CoStar, and rents are still up at least 10% this year. So we're not seeing any sort of slowdown. There's just not enough. I mean, I think this is probably what you tell your students too. I mean, you want to buy in markets where it's supply constrained, right? You don't want to buy in markets like Dallas where everyone's building every single, everywhere you can go. Yeah. In San Diego, you just can't build. So like the rents keep going higher and the weather's great. So people want to move here. There's a lot to do. Yeah. So I always advise people to buy in markets where it's tough to build. Yeah. Well, the whole state of California is tough to build. Yeah. Yeah. Gosh, it's unbelievable. And there was some study that I saw that up in San Francisco, they were trying to figure out why they're having all these problems. And it's their own rules and that is preventing anything from happening. So it's crazy. It's crazy. But all right. So your rents are remaining stable. Other parts of the world of the United States, rents are starting to tank. I looked at one particular study and the guy said the areas that will be most impacted from what's going on in the economy right now are those that had a lot of development, just like you said. They had more development, so they're in trouble because they've overbuilt. And the other thing too is a lot of investor money, and this is more in the housing market. A lot of investor money coming in. There are more investors in that marketplace than they have than compared to other more stable environments. And that's because when the going gets tough, those investors just dump those properties. I mean, I saw this. I'll tell you something, Jason. You probably will agree with me, though you may be offended, and I don't mean to offend. But when we see stupid deals being done in like Texas and our first statement is must be a California investor. Yeah. Honestly, yeah. I mean, that statement is 100% true, and I agree with you because a lot of people I work with, I have exchanged people out of California, and those people that exchange out of California are on a 45-day shot clock to find their property, right? Because they're in an exchange. So they just will go and see what's in the market and overpay for, what's out there. And it seems way cheaper than San Diego, right? Because San Diego or California, things are at like 400 a door, where maybe somewhere like, I don't know, Dallas, it might be half that, right? Oklahoma, 150. Yeah. Yeah. There you go. Yeah. And they can buy a 450 unit complex. How can you go wrong? And if you overpay for a property, you might as well just drop the keys on the bank's desk. And let me give you another quote. There's a guy out there. I'm not going to mention his name right now. I'll let you see if you can figure it out. But the guy out there says that
you should just always keep buying Class A multifamily because the prices will never go down.
I know exactly what you're talking about.
Oh, do it. Okay. And the initials are, give me the
GC.
first. Yeah, you too know what I'm talking about. Yeah, what do you think of that statement?
Look, I had him on my podcast. He said the same thing. His whole argument is that, guys like Blackstone or BlackRock will buy his portfolio. And that's something I just heavily disagree with. I mean, no matter where you buy, I don't care how good the building is or how crappy the building is. If you overpay for it and your metrics are higher than it should be or lower than it should be, then you're going to lose. That's my opinion.
There's a reason why Blackstone has all the money, because they're very smart. I mean, that's why Warren Buffett has all the money. He's very smart. He doesn't pay, like, his powder is so dry right now. I mean, what do they say? He's sitting on $130 billion of cash just to go out there and start buying these things from guys like Grant Cardone that overpaid. And what I used to always say, the guy that said that must be 10 years old, because he never lived through that last crash in the multifamily business like I did and watched my values tank. But I'll, to hear him say that, he has never had to sit across the table from a CMBS lender and try to negotiate with them. Like, why don't we just, blend and extend? Why don't we just try this? Because I did that with my local lender down the street. Those CMBS lenders just look at you and say, no hard feelings. We just take the property back. That's what we do. And that's what they'll do with the Grant Cardones of the world. So
I have a question for you. So do you think the last recession that you went through is going to be similar as now, or no?
Okay. Okay. Here's the difference. Originally, I was always saying that it'll never happen again, because back then we did not have sound underwriting. If you could fog a mirror, you could get a loan. Okay. I shouldn't have gotten some loans on the deals, some of the deals that I did, because they were just not good deals. But then I said, then the banks wised up, and today you have much sounder underwriting than you did before. Okay, that's not the problem that's going on right now. What's going on now is inflation and the recession at the same time. We didn't have all this cash pumped into the economy like we have now, which is going to cause such huge problems. And I was just talking to an investor before I got on the phone today, and he said something that, when COVID was going on, everybody was talking about how, we're going to lose our properties because people can't work. Well, then we got flooded with cash, and that never happened. But what they didn't tell us about, because they didn't know it, is what my client called a COVID hangover. You've got so many, he's got C-class properties, you've got so many tenants that are still thinking that they all have parachutes, and they'll just continue to the government's going to, Joe Biden's Uncle Joe's going to take care of us. And the game's over, and they got to start paying. He said, I got 10 evictions this month on my property. He said, I've never had that before, but I got to get these people out, and I got to start finding people that can pay. And he's calling it a COVID hangover. So I think that's another problem that's happening. But the issue is the interest rates, the Fed tightening the monetary policy, and just watching how it is killing deals.
Yep.
And you know how it is. When from the buyer's standpoint, the higher interest rates are a leading indicator of what the problems are, because they just can't buy and the seller still thinks his baby is beautiful, and he's not willing to reduce that price. No, I'll just wait out Jerome Powell. I'll just wait him out until rates come down. And then along comes the bank, and the bank is like an enema on the economy. They can make things move very quickly. They can get in there and say, hey, your note's coming due. We want to rewrite it? Well, we're going to rewrite it at 65% LTV, and we're going to rewrite it at a higher interest rate. And then you have to sell the property or give it back. It's just a numbers game. That's all it is. And when the banks have to wait until their terms are up, which is a lot different than cranking up their interest rates today. The banks, when these notes start coming due, that's when you're really going to start to see some price pressure on the sellers.
Do you see? I'll say in my opinion too, but do you see rates continually going up in 2023?
Okay, first off, I'm waiting for that first adjustment by Powell, because then I'm going to start buying short in the stock market, because according to one guy, he did a whole study and said that over the last 8 recessions, when the Fed has cranked up the interest rates, as soon as the director ratcheted it back down for just the first time, from that point on, 18 to 24 months, the stock market dropped. Every single time it dropped. So I'm waiting for him to make that first adjustment. And one of my students on our Monday night call made a very interesting point, and he said that that he can't keep going up to get inflation under control, because it'll destroy this country with the national debt. We cannot afford to repay our debt at this level of interest rates. It'll cripple us. So Powell is going to have to suck it up a little bit and let inflation, remain. But he's got to start bringing these rates down. And therein lies the issue, Jason. Therein lies the issue. If you're an owner, do you sit and wait, or can you outlast your bank? You can never outlast a CMBS lender. You might be able to, outlast the local lender, but you can't outlast CMBS. So, what do you think?
Yeah. I mean, the people who bought bad opportunities in the last, run up are definitely going to be hurting, and are probably worried right now. I mean, I read a story the other day about an investor group who bought a $40 million portfolio in Vegas, and that same portfolio appraised for $36 million. And recently, and they have a bridge loan coming due within the next 3 months because they got a 1-year arm, and they're screwed. Yeah. So, I mean, I see rates staying high. I mean, I see them coming down a little bit, but I think Powell will definitely try to keep them somewhat elevated to try to control the inflation. But like you said, if it goes too high, then the whole economy could get screwed. So exactly. I agree with everything you said.
Yeah. Okay. Let me ask you a question. Something you just said. You said the biggest problems are going to be those bad opportunities. Explain and define for me what you consider a bad opportunity.
I mean, very simple. A bad opportunity is if you bought a property in any location, doesn't matter where you are, but if you bought a property if you were the highest sales comp in town at the time when you bought that property, that's the key indicator of buying a bad opportunity. When we buy a property, we look to buy at least 20 to 30% below market value with upside, so that we're, controlling our cash flow. We know exactly what the property will be worth. But if you're buying, especially an older property, if you're buying a Class C property and there's no room for upside or to increase values, and you're just betting on rents going up every year, you're probably screwed right now. So it's a bad opportunity.
Exactly. Paul Moore wrote, one of his good friends, I've been on my podcast a couple of times. He said it best. He said, investors don't care what the market's doing, because they, as experts in multifamily, they know how to unlock value in a property. If the market goes up, bonus. If the market goes down, okay, but they know how to do it. And those are the people that look at the property and see where can I force appreciation, value adds, high loss to leases. Those are true investors. He said exactly what you just said. Those people that overpaid for their properties and they just got into the market hoping that the numbers would continue to go up are the ones who are going to get beat up so badly in this. And I'll tell you something, Jason, this is not a slight on you as a broker, but just look at it this way. Those investors were acting like brokers because they were in those deals, not because it was a good deal, but for the transactional income that they derived from the acquisition fees. That's what brokers get. And they did their job. You're an investor. You can't be in it for the 3%. I'll tell you, back in the day, I walked home one time with a $250,000 acquisition fee at the closing table. And that property never came. 2 months later, Fannie and Freddie go bankrupt, and that property never came back in value. But I got my acquisition fee. But that was the wrong thing to do. That was the wrong way to look at that deal. And that's how people should be thinking about, when they're looking to invest in deals, think about that. I saw one deal the other day. It was so ridiculous. they had like 10 GPs. 10. And they were all couples, like husband and wives. Oh, they're all, in this together. As soon as that market changes, how many of them are going to be sticking around when they find out they're not going to make a dime at the end of the day? They all got their name on the dotted line just so that they could say that they were a GP in a deal and put it on their resume. Who cares? It's all about, bringing that deal in for a landing. That's
Exactly.
That's the key. So, yeah. So, wow. I mean, Jason, what you look like you're what, 30 years old, you're standing in San Diego, you're wearing a vest. We wear that type of a vest here in New Hampshire on a 20-degree day, which you've never seen before in your life in San Diego. So, like what's next for you?
Yeah. It's funny. Yeah, I'm actually, 25 years old, so a little younger than you thought.
I didn't want to go too low. I did.
Yeah.
Yeah.
That bio's a little old too. I mean, I've sold, a $250 million worth of real estate.
There was a broker in Texas, a Marcus & Millichap broker, and he was, how they do it, they put everybody in teams. So he had this team and he was the leader of this team. And I remember when I met him for the first time, walked in, and I took one look at him. He goes, I know you're expecting someone older or somebody younger. And I was like, yeah, because this kid looked like he was 25 years old, but he was fabulously successful. Nick, I think his first name was Nick. I can't remember his last name, but
Gotcha.
Yeah. So that's great. You're 25. Wow, you're killing it, man. So yeah, then I got to ask you, you obviously haven't been through one of these cycles before, but you seem like you got your head on straight. You know how this works. So what's next for you?
Yeah. I've learned from people that are much smarter than me and wiser than me who've been through a lot of cycles like you have. What's next for me is I have my own brokerage. It's JLM Real Estate. I started last year, and we're off to a hot start, doing really well. Team about 8 agents, looking to grow that company. But I spend half my time now looking for properties to buy. Gotten a lot pickier lately, but just trying to grow the portfolio and grow the brokerage.
Okay, that I got to tell you, if I was 25, I wish I was doing that myself, because I think, there was one guy that I went to high school with. His father owned like 2,000 units right here in my town, and he started off as a real estate agent, and he would buy a 2-family and then buy a 3-family, and they just started, and before long he was a fabulously wealthy, because that's, you guys obviously have a nice little advantage. You know how to find the owners. You know how to talk the price, you know how to make things move, and you're doing it very, very well. And just to, you say guys like me who have been through it before. One thing that I've learned over time is the older I get, the smarter Warren Buffett becomes. So keep watching what that guy's doing. He's doing everything the right way. These people that I was on that multifamily shark pool a while back, and I just saw some of the stupidest deals come up, and all new investors, all thinking that the skies, trees grow to the sky, and then we're listening to the Grant Cardones like no prices are ever going to go down. That's such foolishness, and I hope I talked some of them out of their deals. I told one guy on the call, you are going to lose money in this, and you won't even close this deal. And sure enough, I got one of the GPs called me back and said, yeah, I lost $75,000 on my own money, and we lost $500,000 total. And we wish we had listened to you or got your advice. Yeah, beforehand. I saw it coming a mile away, knew exactly what they did wrong. And you want to know how I knew, Jason?
How'd you know?
Because I did it one time myself. So yeah, it happened to me. So, hey, Jason, you're a good guy. I'm glad to have you on my show. It's this has been very cool. You're 25 years old, but you're talking like you're 50, and I think you're going to do some great stuff. I think it's going to be a lot of fun to watch it. So give a plug. What was our website again?
Yeah, thanks, Charles. Website is jlmrealestateinc.com, and then all my socials is my full name, Jason Joseph Lee.
Jason Joseph Lee. Cool. Very Jason Joseph Lee. Very well. Lee is obviously an Irish last name, right? Right? No?
Yeah.
Okay.
No.
Yeah. See, that's what when I met a guy and his name was Lee, I was expecting to meet a Chinese guy, and he was Irish. And I said,
Whoa.
really? Yeah, that's also an Irish name. So you got that going for you. You got the luck of the Irish going for you. So,
Yeah.
All right, man. Good to see you. Thanks for being on my show. We'll talk soon.
Hey, thank you, Charles.
Thanks. Talk to you soon.